Okay, you have to see this. The stock market is soaring. It's getting super close to all-time highs. But at the exact same time, some of the best companies out there are hitting their lowest prices in a year. So what on earth is going on? I mean, just look at this. The Nasdaq rocketed up almost 5%. Not in a month, not in a quarter, in one single week. After a bit of a dip, the rebound has been, well, absolutely ferocious.
So that's it then. Game over. You missed the boat, all the easy money's been made, and everything is just way too expensive again, right?
Well, not so fast. And this, right here, is the paradox that's messing with everybody's head. On one hand, yeah, the S&P 500 is roaring back. It's just a stone's throw from a new record. But on the other hand, you have this weird situation where a whole bunch of really solid quality companies are quietly hitting 52-week lows. So let's break this whole thing down. We're going to make sense of the confusion, and I'll show you two very different ways you can play this market. And you're definitely going to want to stick around because at the very end, I'm going to give you the one simple three-point check that separates a true bargain from a disastrous financial trap. All right, first up, let's talk about the market's crosscurrents. This is the source of all the mixed signals, and it's exactly why investing feels so confusing and, frankly, a little weird right now. See, if you peek under the hood of this big rally, there's a lot of stuff to be nervous about. You've got the threat of inflation coming back because of oil prices. There's always some geopolitical drama bubbling up. A lot of people feel like this whole rally just went way too far, way too fast. And the big central banks, they don't have as many tricks up their sleeves to save the day this time. But the big one, this whole thing is being propped up by just a few mega companies. If they sneeze, the whole market could catch a cold. So with all that swirling around, these huge rallies, but also these hidden risks, how on earth do you actually find a real opportunity? How do you invest with any confidence? It turns out there are really two clear paths that investors are taking to cut right through all this noise. And they couldn't be more different. Path number one is good old-fashioned value investing. You can think of this as being a treasure hunter. You're sifting through the rubble looking for amazing companies that the market has tossed aside for some silly temporary reason. And path number two? It's the polar opposite. It's called momentum investing. Forget about bargains. This is all about finding the strongest stocks, the ones that are already sprinting ahead, and just jumping on for the ride. The whole idea is that winners just keep winning. Okay, so let's walk down path number one first. This is for the value hunters out there, looking for those hidden gems among the market's forgotten stocks. Now, this table gives you a perfect snapshot of what we're talking about. These are companies that have strong numbers, good returns, not a lot of debt, but for whatever reason, they're trading near their lows. So you look at a company like Covi Medical. Great financials, but it's a smaller company, so you know it's going to be a bumpy ride. Or Apollo Tires, a fantastic business, but they can get squeezed when their material costs go up. You see the pattern? Each one has something really great going for it, but also a clear risk you have to be okay with. All right, let's flip the script. Time for path number two. We're forgetting about the bargain bin and looking at how to ride the momentum wave. These are the undisputed leaders of the pack right now. You know the big names. Amazon and Meta just had absolutely monster weeks, soaring by double digits. That's not a bargain signal. That's a power signal. It's telling you the big money is piling in. Then you've got interesting names like StoneX, where you get both the stock price going up and analysts raising their future expectations. These are the stocks that are already out in front, leading the race. Okay, so you see the two strategies. But this brings us to the single most important question, especially for you value hunters. How do you know for sure that the cheap stock you found is a genuine, undiscovered gem and not just a trap that's about to blow up in your face? The answer comes down to this one critical idea: the value trap. This isn't just a great company having a bad month. A value trap is when a business is fundamentally, maybe even permanently broken. The stock is cheap for a damn good reason. So just like I promised, here it is, your simple three-point fact check to help you steer clear of these traps. First, check the earnings revisions. Ask yourself, are the experts constantly lowering their forecasts for this company? That is a massive red flag. Second, look at the debt. Is it piling up and becoming a real problem for them? And third, see what the big money is doing. Are the giant investment funds selling off their shares and running for the hills? If you see these signs, you're probably not looking at a bargain. You're looking at a trap. So after looking at both of these paths, that leads us to our question of the day. Which one are you? Are you a value hunter, always digging for that diamond in the rough? Or are you a momentum rider, looking to jump on the fastest horse in the race? Let us know your style down in the comments.